When it comes to trading options, you basically have two choices. You can either sell them or you can buy them. Now, of course, buying options can be much more enticing because you do have that theoretically infinite profit potential, assuming you're not buying debit spreads, right? If you just buy a call option or you buy a put option, then yes, you do have unlimited profit potential for limited downside risk. Now, that being said, in this video here, I'm going to carefully walk you through 5 very specific reasons why selling options is actually, in the grand scheme of things, much, much better than buying options. Because as you'll see throughout this video, when you buy options, that does carry a lot of hidden disadvantages that in the long term makes it super difficult to be consistently profitable. And actually, all those disadvantages flip and become advantages when you sell options. And also, I do know that this video is going to be one of my longer ones, but that's only because it is jam-packed with a lot of information and detail, so be sure to stick around for the full video, especially for the very last reason. Because that last of the 5 reasons you're going to see in this video is the core idea of my entire approach to options trading that you see in all of my live trading videos. And of course, before we get started here, in case you are brand new, my name is Scott Reese, and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, now we're going to jump on over to ThinkOrSwim and we'll get things started. Okay, let's dive in here now. And so the first reason why selling options is better than buying options has to do with implied volatility overstatement. Now, first of all, in case you're not aware, what is implied volatility? Well, for example, what you're seeing here is a simple price action chart of Peloton stock. No special reason. This is simply a stock I like to trade pretty often, but down here below in this chart, this is showing you the implied volatility for Peloton stock over the past 1 year. Now, I've said in many of my previous videos that conceptually speaking, implied volatility is simply a measurement of fear or uncertainty about Peloton stock's future in this case. And the greater the implied volatility during a certain time period, the greater the fear or uncertainty about this stock's future. And this concept is one of the most crucial components of an options selling strategy because implied volatility is baked right into the prices of option contracts. And in particular, when implied volatility is high, so will be the prices of the options. They'll also be very high. So of course, as an option seller, you're going to want to step in during times of heightened fear and sell those expensive options. Now that's the more conceptual definition of implied volatility. There is also a much more technical definition. And that is implied volatility also is a measurement of the expected future price move of Peloton stock at some point in the future, typically by default 1 year in the future. So as you can see right there, the current level of implied volatility for Peloton is 66.24%. Implied volatility is always measured as a percentage. And so again, by default, what this means is 1 year from today, the market is expecting Peloton stock to be either up or down by 66.24%. It does also get a bit more technical than that in terms of standard deviation and things like that, but for the purpose of this video, that's all you need to understand. And we can actually see this visually on the Analyze tab here. So this chart is showing you the expected price moves of Peloton stock based on the current level of implied volatility at any point in the future. So for example, on the y-axis down here, this is the number of days out in the future that you're looking at. So for example, we can go to 1 full year, which is of course 365 days. And on the chart, that would be somewhere around here or so. I'm recording this video on October 31st, 2021. So as you can see below, October 31st of 2022 is exactly 1 year in the future. And again, based on the current level of implied volatility, by this date, the market is expecting Peloton stock to be somewhere in between a high right around, call it 142-ish bucks per share, which you can see on the y-axis there. So 142 to 143, somewhere in there. And a low of about, let's come back to the y-axis here and get the dates lined up again. So October 31st, 2022, and a low of about, call it 37 bucks per share. So anywhere between 37 bucks per share and about 142 bucks per share 1 year in the future is what the market is currently expecting and pricing in. So that's implied volatility. Now, what about the implied volatility overstatement that I mentioned earlier? What does that exactly mean? Well, it means exactly how it sounds. Implied volatility is oftentimes overstated, or more specifically, or more technically, the expected price ranges in the future are too large. So even though the market is decently accurate at forecasting the future, it's not precise. And so the vast majority of the time, what you'll find is if we fast forward that 1 year, it's going to be very likely that Peloton stock will have moved well within the expected amount, right? Perhaps Peloton only moves up by $10 or so, or maybe it moves down by only 7. Either way, most of the time, the actual moves of the stock over the certain time period that you're looking at are almost always a lot smaller than the full expected amount. Again, these expected price ranges are almost always too big. And so finally, why is that important? Well, it's important because, as I explained, implied volatility, these expected price ranges are baked in to the prices of the option contracts. And if implied volatility most of the time is overstated, then that means the prices of all these option contracts on Peloton stock are inflated. They're too high. Because again, keep in mind, as implied volatility expands, so do the prices of the option contracts. And then conversely, as implied volatility contracts, the prices of options will come down too. And right now, if the implied volatility of Peloton is around 66%, and if this number is overstated, right, perhaps a more realistic number should be maybe 50% or 40%, not 66, then once more that simply means that the prices of all the options on Peloton are too great. And therefore, you should ask yourself this one simple question. Does it make more sense to sell an overpriced product than to pay extra money to buy the overpriced product? What makes more sense? And hopefully your intuition should tell you that it makes more sense to sell an overpriced product. And one more thing I want to mention here before moving on is I just want to reiterate that implied volatility is overstated most of the time. Not all the time, but simply most of the time. And based on my own research and the research I've seen from tastytrade, these expected price moves are overstated about 80+% of the time, the vast majority of the time. And of course, it only makes sense to put those odds in your favor and be on the selling side of option contracts. Now moving on to the second reason why selling options is better than buying options, and that is when you sell option contracts, you can give yourself very high probabilities of profit, and you actually have complete control over the specific probability of profit that you want to target. So for example, here I'm in the November expiration cycle with 19 days left to go. If I was bearish on Peloton stock and I wanted to sell, let's say this call option right here, this is the 101 strike call option, then that means all I need over the next 19 days to make a full profit, which would be about $255 or so. All I need is for Peloton stock to be below 101 by the expiration date. And right now the price of Peloton stock is $91.44. So this stock can go down. That's what I would like to see. But of course, it can also go sideways, and it can even increase in price all the way up to $101 per share. In any of those three situations, I still walk away with a full profit. And again, using the implied volatility that's baked into the prices of these options, you can actually calculate the specific probability of profit for selling this one call option. And that's what you can see in this column right here, 24.27%. This is the chance of Peloton stock expiring above the strike price for this call option of 101. And right now there's only a 24.27% chance of that occurring, which means taking the inverse of this probability, that means you have around a 75% chance of making a profit on this trade, a full profit. And of course, Peloton stock can actually breach your call strike by a small amount come the expiration date, and you can still walk away with some profit. And that's because when you sell this call option, you'll collect about $255, and you can use some of that money to offset any losses you might face should you get assigned on this call option. So that means your probability of making any profit, not just a full profit, is actually even higher than 75% or so. It might be 77 or 78%. And these super high chances of profit are just not feasible to create when you're buying options. Right? For example, if I instead bought this call option, everything just flips. I would no longer have around a 75% chance of making a profit, but it would be less than 24. Those odds are obviously very, very against you. Now, one thing I could do is buy a super far in the money call option. As you can see with this 77 strike call option, this one has about an 80% chance of expiring in the money, an 80% chance of Peloton stock being above $77 per share, but you're still going to need Peloton stock to increase in price to actually make a profit on this trade. And that's simply because you have to overcome the extrinsic values still remaining in this contract. So basically, unless you see a huge, incredibly large explosion of implied volatility, which almost never happens, then whenever you are buying option contracts, you must be directionally correct to make a profit. Moreover, just to buy this one contract, I'm gonna have to put up almost $1,600 of my own money. Whereas again, for selling this 101 strike call option, let's go ahead and set up the order here and see how much money I have to put up to sell this one contract. It's only $915 of capital. So again, by selling an out of the money call option, I put up less capital, and also Peloton stock can move pretty much anywhere. It does not have to go down in price. It can, or it can go sideways, or it can even increase in price to a significant degree, all the way up to $101 per share. So once more, just like with implied volatility, put the odds in your favor. The vast majority of option contracts do expire worthless. So why would you not take advantage of that? Next up, the third reason why selling options is better than buying options is because you can always extend your trade duration for more money, right? If I sell this call option now, then I do want Peloton stock to be below 101 by the November expiration date in only 19 days. But what if Peloton stock actually has a huge rally between then? And perhaps maybe when there's only a few days left to go until the expiration date, what if Peloton stock is all the way at $110 per share? If I don't want to get assigned and have to short shares of stock and immediately realize some huge losses, I can extend the duration on this trade and also take in more money at the same time. And the way I would do that is simply by buying back this call option and then selling a new call option with the same or very similar strike in the next expiration cycle. So now in December, as you can see here, unfortunately there is not yet a 101 strike call option, but instead I can sell the 100 strike call option, and that's definitely close enough. So again, if I buy back this call option for about $255, let me pull up the calculator here. So $255, and that's obviously going to cost money, right? And then down here below, in the December expiration cycle, I can sell basically the same exact contract for around $450. So in the end, that brings in a net additional credit of $195. I've extended my trade all the way to the December expiration cycle and at the same time took in extra money. And you will always be able to do this for any contract that you roll out in time. And that is simply because options with more time baked in are always going to have greater prices. It's as simple as that. And comparing this to buying options, it's just the inverse. If you wanted to extend duration for a long option position, you would actually have to pay money to do so, right? Because that means if I bought this call option initially, I would have to sell it and get rid of it. And of course, I could only sell it for about $255 and then buy a new contract in the December expiration cycle for a lot more money. So instead of receiving a $195 credit, I would actually be paying a $195 debit. And the more times I roll my contracts out in time as an option buyer, the more and more risk I'm just piling on. But when you sell options, you can simply roll them out in time indefinitely and collect more and more credit every single time until eventually, just by doing that, even if your option is in the money the whole time, eventually those additional credits you're receiving can overcome any losses that you're facing on the contract. And so now moving on here, the fourth reason why selling options is better than buying options has to do with time decay. And for this one, I do have a visual that I would like to show you. And so I believe I have demonstrated this spreadsheet in previous videos of mine, but I'll show it here again. And so let's say we have a stock that's currently trading for $50 per share. And I'm looking at trading a call option with a strike of 55. So $5 above the current trading price of the stock. And let's also say the current level of implied volatility is 75%, and the short-term risk-free interest rate is 1%, although this is kind of irrelevant for this example. So based on these inputs, if I come over here now to this chart, here we go. So this chart is showing you the price of that call option every single day over 1 full year. So as you can see down below on the x-axis with days to expiration, that call option with 365 days left to go would be worth around, call it $13.14 on a per share basis, or $1,314 in total. Now this chart is isolating the time decay component of option pricing. So if we hold everything else constant, if the stock price stays the same, implied volatility stays the same, etc., then as you can see over the 1 full year until the actual expiration date, the price of this call option is going to slowly get eaten away. And this is exactly what time decay is. As time marches forward, the value of all option contracts will slowly deteriorate. And this happens regardless of where the stock actually moves or where implied volatility actually moves. But again, just in order to see the full clear impact that time decay has on option prices, that's why this chart is assuming everything else is held constant. And especially as you get pretty close to the expiration day, time decay does accelerate. And ultimately, this concept here always works against you as an option buyer, right? The whole point of buying any asset is that you hope the price of that asset will increase. But if the asset or the product that you're buying always has a component in its pricing model that eats away at the value, then you're basically just shooting yourself in the foot, right? Because maybe you bought a call option with 100 days left to go into the expiration date, and you gave yourself a lot of time to be correct, but maybe 2 or 3 weeks go by and the stock price really has not moved, and implied volatility is also basically the same. Well, then even though basically nothing has changed, nothing has moved, you're still going to be down money on your position. And that's because your call option will have lost some value simply because of the passage of time. And now, in order to make up for those losses, you're going to have to be even more directionally correct should the stock actually ever move in your favor. And the longer that move does not happen, the less and less likely you're ever going to make a profit on your position. And conversely, this works in your favor as an option seller. The whole point of selling options is to either have them expire worthless, and time decay obviously will help you with that, or to simply buy back the contracts for a much lower price. So of course, if I instead sold a call option with 100 days left to go, then if 2 or 3 weeks passed by and nothing really changed in terms of the stock price or implied volatility, well, it doesn't matter. I'm still going to be up money on my position because now I can buy back the call option for a lower price and make the difference as a profit simply because of the passage of time. That's it. So once more, put the odds in your favor. Take advantage of the pricing structure of option contracts and sell options. Time decay will always work against you as an option buyer, but it will always work in your favor as an option seller. So why not sell options? And then finally here, the last reason why selling options is much better than buying options has to do with the fact that you can play both sides of the market as an option seller. Now, what do I mean by this? Well, when you are selling options, you are essentially selling stock insurance. Right? For example, if I sold this 90 strike put option, that means of course someone had to buy it from me. Now, why would somebody potentially buy a put option from me? Perhaps it's to protect themselves from losing money on a long Peloton stock position, right? If somebody out there bought 100 shares of Peloton around $90 per share, and they want to protect or insure themselves against the stock price dropping and losing money as a result, they could buy a put option. Right? Because doing so will always allow the buyer of the contract to sell their shares at basically the same price that they bought them at in the first place. Now, most of the time, insurance in general is never used. Think about your car insurance. You pay your car insurance company every month or every 6 months, depending how your payment plan is set up. But how often do you have an accident? Almost never. And so with the stock market, of course, accidents do happen probably a bit more often than car accidents. But stocks do generally climb higher, especially for well-established and quality companies like Peloton or Apple, Google, Microsoft, etc. So the chance that the buyer of this put option will ever need to use this put is probably pretty small. And therefore, as an option seller, as a stock insurance provider, I can keep collecting these monthly premiums every single month and walk away. Now, that being said, at some point, of course, the stock will drop significantly, and in which case that is the accident, right? And the buyer of the put option contract is going to want to use their put option to recuperate their losses on the stock. And those losses that they're able to recuperate come from who? Me, the option seller. Someone's going to have to lose that amount of money. Same thing applies to your car. If and when you have an accident, your car insurance company is going to have a huge payout to you to either repair your vehicle or buy you a whole new one. And there is no way for a car insurance company to get around those infrequent but very large, hefty payouts. But for an option seller, there is a way to do that. And that's why I said as an option seller, as a stock insurance provider, you can actually play both sides of the market simultaneously. And this is what I do with my own strategy. I can sell this put option, for example, and then should the stock actually fall below my 90 strike, I can short 100 shares of the stock. And in that way, let's say by the expiration date, the stock drops down to $60 per share. Well, in that case, the option buyer is going to want to use their insurance to recuperate their losses. So they're going to exercise their put option. I'll get assigned on it and have to purchase 100 shares of stock at my strike price. But if that's where I shorted those shares to begin with, then buying them back at the same price, I'm fully made whole. I don't lose any money on the stock. Moreover, by buying those shares and fulfilling my assignment on the put option, I've made the put option buyer whole as well. That person has recuperated their losses, I've met my obligation on the contract, but I also don't face any losses. I shorted the shares at $90 per share. I bought them back at $90 per share. Nothing changes, except I still walk away and keep the full premium for selling the put option in the first place. That's what I mean by playing both sides of the market. And so if car insurance companies could do something like this, it would basically be the same thing if you had an accident, that your car insurance company could basically spontaneously create a whole new vehicle for you for free and just hand it to you. Here's your new car. No cost for the car insurance company, no cost for you either, except of course the premium you paid for the insurance to begin with. Everybody is made whole and we walk away. And so ultimately here, this entire approach only works when you sell options. You have to take in credit to begin with. That's the profit you're trying to make by the expiration date or sooner. And then you're simply using the stock to cover your obligations on the insurance, on the contract, should the insurance ever need to actually be used. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.